But thank you all for coming and joining us and venturing forth. This is our second event this year that we've done live. In May, we had the food truck outside, which we had such a good turnout with that last fall when we did it, that we repeated it and had a great turnout again. So you may see that one circle around every year. We were glad we were able to do this event live. It's much better. Last year and in January, we do these presentations on the economy and the markets twice a year, January and July. And the last two, of course, we've done virtual. And doesn't have the same effect. It's nice to engage with people. So thank you again. Mid-year Outlook. This is really to take us from our January presentation to now. Not much going on really in the last 6 months, right? Right? I overheard a couple of conversations. What's probably the biggest economic talking point in conversations today?
Inflation.
Inflation. And it all ties together. So in my intro here, and I'll look at my slides because I have some statistics that I wanted to share. But one of the themes is the recession that came out of COVID last year was not normal, because most recessions are driven by issues that are occurring in the economic marketplace. There really weren't any issues. In February of 2020, the economy was really doing well. COVID came, closures of businesses came. It really set everything back, and so because that wasn't normal, the turnaround is a little abnormal, and we're still seeing, why that is. And so we're having a real strange business cycle here that's going to continue for a while. And we'll talk about some of the unprecedented things that have come out of the last 18 months and really what we've seen in the last 6 months more than anywhere else. But so these are a couple of the big talking points that we've seen. We talked about inflation, of course, but employers are dying as they've opened to fill their employment roles, and there's jobs being posted across the country. The number of job postings that have gone unfilled have gone up every month since January. They reached a point at the end of April that there were 9.3 million job openings that were unfilled. And again, they've gone up every month since January. That started to flatten out a little bit in May and June, so that's a good sign. But because of that, employers have to pay more money to people that are willing to work. That drives up inflation because there's wage inflation. Why are we seeing this? Primarily because there's stimulus money adding to unemployment and people aren't working. That should go away when those benefits come off the table in September, the end of September. They've started to come away now because I think half the states in the country have already taken those benefits off at a state level. So that's why we're starting to see that get better. Everybody here's about the supply chain, right? There's going to be a continued ramp up before that issue gets fixed. Lumber and building supplies had gone up from April of 2020 to April of 2021, 300%. Lumber in particular. Supply chain issue. That one started to kind of fix itself. Do you know anybody that's tried to buy a car in the last 3-4 months? Forget about it, right? I have a good friend who's also a client that runs a local Ford dealership. He had 3 new cars on his lot this weekend. And they normally have 40, 50, 60. Ford announced, just a couple of weeks ago, they're not manufacturing 3-4 different models or makes of cars until next year. The median sales price of a new home sold in March of this year was $372,000. It's an all-time high. all-time high. Not in like the last 10 or 20 years, all time, right? Existing home, the average sale, so that was median, the average sale price of a new home as of the end of March was $435,000. That was an all-time high as well. Existing home prices have risen for 39 consecutive quarters through March 31st of this year. So that goes all the way back to 2016. The existing sales of existing homes, the prices have gone up every quarter. So when we say unprecedented times, it's because we're seeing numbers that we've never seen before. Here was another interesting statistic. Americans imported $278 billion of foreign goods and services in March and $274 billion in April, the two highest import months in U.S. history. That's a function of stimulus, right? People have money, plus pent-up demand and energy because they had nowhere to go, nothing to do, and nowhere to spend their money. How does that translate into the markets, right? There's a bit of market exuberance. The market's catapulted back, which will toot our own horn. When things went bad in February and March of 2020, not only did we stay the course, and most of you did that with us, and didn't panic, but we took steps because we truly believed that it was, a false pullback to shift some lower risk assets into higher risk to take advantage of that downturn, and it really worked for us and benefited all of you. But there's been some newer trends here in the last 6 months. Access to tools and things like overusage of margin, and I won't get into the details, but I'll share a couple of slides with you. And then there's some risk in the market because there's only a handful of stocks, the top 5 holdings, you can probably guess the companies, that are dominating the S&P 500. So if something goes in a different direction on those 5 companies, it could bode ill of what occurs. So I talked about new tools. The other thing was with people shut in, they had a lot more time on their hands to kind of experiment with things. So retail investors have been using these tools to communicate with one another, to look for tips, to share ideas, to jump in on GameStop. We all heard about that a while back. That all happened through a place like Wall Street Bets and Reddit. And then they have access to platforms. Robinhood in particular is one that we hear a lot about or have heard. We're easy trading at zero or no trading fees. Or very low trading fees. So it's really driven a lot more retail investors, what we do. Margin. If anybody doesn't know what that is, it's the ability to not use cash to buy securities, but to use your security portfolio as collateral to buy additional securities in that portfolio. So you're taking on debt. And we're seeing a lot more of that over the course of the last year plus. And that's risky, not to any of you, of course, but it's a risky sort of play in the marketplace. It could have consequences, if there's a significant pullback. And then this is what I was talking about. Everybody can see it pretty well up here. This goes back to 10-year period, goes back 20 years. What were the top 5 holdings of the S&P 500? What percentage of the total S&P did they make up? And you can see the 5 companies that were there going back to 2001. Similar mix of companies in 2011. Apple's the only one that carried forward into 2021. And these companies make up almost 21% of the S&P 500. So as they go, the S&P goes. So if Facebook runs into, or any of these companies run into issues with monopolies and things like that, that could break them up, that could pull them back a little bit. So again, there's risk there This is the kind of stuff that we pay attention to in our investment committee meetings, plus in our meetings with our investment partners. But what are the key takeaways? There are signs of exuberance. Doesn't necessarily mean a reversal. We feel pretty strongly, based on all the data, that the markets are going to hold up pretty well here. But it gives us an opportunity to do what we think we do best, which is reassess where things are concentrated, how asset classes are looking as we go forward, making adjustments in the various areas of your investment portfolio.
Thanks, Chuck. I think I know almost everyone in here. My name's Tom Vickers, if you don't know me. And I'm going to move a little bit just into some broad economic themes that are happening in the economy right now. And what we're showing you here is back last year, in 2020, what happened in the markets as far as gross domestic product of the United States and the world, what our projections were at year end in the middle, and what our change in projections is now for the rest of 2021. And I'll point out, in 2020, the United States economy dropped 3.5%. That was the largest pullback in economic development since the Great Depression. So it was a pretty devastating year just to see a 3.5% pullback. And I think ex-US around the world, it was 3.9% pullback. So that was pretty significant. But as Chuck had mentioned or alluded to a little bit, with many Americans getting vaccinated, and with the, we call it the reopening trade, where there was so much pent-up demand. People were tired of being locked in their houses for well over a year, and people want to go to the movies, they want to go on airplanes again, they want to travel, they want to go bowling, all these things. There's just a ton of pent-up demand. And the federal government was pumping tons of stimulus out to individuals via just hard checks. And people didn't really have the money to spend. I mean, they didn't have anything to spend it on. They weren't going to restaurants, they weren't doing these things. So they were just sitting on their savings. Now with the economy and our country reopening, you're seeing just explosive spending and growth going on. We think that's going to continue, at least for the next year and a half. So that's pretty exciting. Developed markets are the large G7 countries, Italy, Great Britain, Japan, Germany, those types of countries. They were down 3.9%. Emerging markets like China, India, Brazil, they didn't get hit as bad, sort of surprisingly. And China was one of the first countries to really come out of this. And so emerging markets were down a little under 1%. And if you average it all out, it was 3.3% drop last year in growth, in gross domestic product, which is still a very significant drop. You can see what we were projecting going into this year, and now you can see our revised projections for how 2021 will turn out. So basically, we're projecting 3.9% growth for the United States. We're now saying it's going to be 6.25% to 6.75%. And that's massive. That is huge. Ex-US, not quite as much, because if you've been reading anything about Europe and whatnot, Japan right now with the Olympics happening in 10 days, they're still struggling with COVID, and we don't think they'll have quite as much growth as us, but they're not that far behind us. So once they get things a little bit more under control, we can see that sort of exploding also. Emerging markets, not far behind US, and global, if you look at the averages, 5.5% to 6% growth. So those are pretty amazing numbers. So next, we want to talk about a little bit about how long will this expansion last. So we went into the shortest lived recession when COVID hit, and we think it's pretty much over. The government announces when recessions end. Usually it's a good 9 months after the recession actually ended. We think it's already ended. So it was a very, very short recession. But here you can see how long economic expansions lasted, going back to World War II. And you can see the average is 5.3 years, all economic expansions. However, the last 4 have lasted much longer. If we go back to 1982, the average is probably closer to 8.5 years that the average expansion has lasted. And this one, the one that started after the Great Recession in 07, 09, that one lasted almost 11 years. And it really only ended because of COVID. So how long will this one last? No one knows. But we think a couple things here. One, coming out of this recession is different than past recessions that we've come out of. Usually we come out of recessions after the market works out excesses. And here, there really were no excesses. It was primarily driven by COVID. So this one we don't think will last quite as long as the economic expansion as some in the past. But if you just look at the average of 5.3, we think we're about a year into this expansion. We still have a good 4 years to go, probably at least, in this expansion, and hopefully longer. We'll see. Some of the things going on and why this one may not last quite as long. Corporate debt is at very high levels, higher than we've seen in a long time, and corporations have been taking on debt because interest rates are so low. So money is almost free. So that can sort of rationalize them doing it, but still it is high, and stock valuations never really had a chance to reset. Normally when we go into a recession, if you remember 07, 08, 09, the market dropped tremendously, and then it sort of bounced around the bottom, and then it went up very rapidly. This one, we went into the recession in COVID hit. I don't know what was it, February, March. March, and by July or August, the market dropped 34%. The S&P 500 dropped 34%, but by August we were back to where we were, and that's crazy. So it never really had a chance to reset, reach its bottom level like we normally see in recessions. So we'll see what happens this time, but we still think there's a lot of legs, left in this expansion, which is encouraging. So here, what we're looking at is there are some concerns, facing markets going forward. One of them is what we call twin deficits. We think are going to put pressure on the United States dollar for quite a while. And when we talk twin deficits, we're talking 2 things. We're talking the current account balance, which is just the value of trading going on around the world with our other trading partners around the world, plus the current deficit. And what we're looking at here is the blue line is the value of the dollar, and you can see it's down to about 80% of being full value. And on this side, we're showing these 2 deficits, the current account plus the budget deficit as a percentage of GDP, and this is bad. So it's about 19%, which is very, very high compared to what we've ever seen historically. So, we do have some debt, but we think that that is offset to some extent by the low interest rate environment that we're in. So we'll see how that plays out. But when the US dollar is going down or is weak, that leads to a couple things. So one is global companies that trade globally, like Apple and many of the other ones that Chuck had up there. Their products become cheaper, internationally. So it's actually good for them, and it also can be good for jobs and bring jobs in. It's a negative if you're traveling, around the world. You're going to pay more if you go to Italy or Spain because your dollar's just not buying as many euros. So that's a negative. And the other negative is that imports become more expensive. So, and Chuck mentioned, what was it, $280 billion of imports over the last couple of months. So those are going to become more expensive. So it's sort of a trade-off, and we'll see how it plays out long term. But it's just something to keep an eye on, I would say. Here we're looking at the other not great, but risk facing the markets are higher taxes. So the Biden administration is talking about raising taxes on a couple of fronts, one of which is corporate taxes. So they want to raise, the Biden administration is proposing raising taxes on corporations from 21%, where they are now, up to 28%. That will be a direct proportionate hit on corporate earnings, and corporate earnings are what drives the stock market. So we think 28 is a non-starter. We don't think he's going to get that, but we do think it's going to settle in around 25%. So that will hurt future earnings, which could hurt the stock market a little bit. And here we're just pointing out that it's not necessarily a deal killer, for the stock market. Here's what has happened over the last 7 or 8 times that the government has raised corporate tax rates. And you can see the last, going way back, it's a mishmash. We have some ups, we have some downs. I'm looking at how the market has done the last 12 months. But on average, the stock market still has gone up 4.2% on average when the government has raised corporate tax rates. And the markets have been positive 62% of the time. So just because they may raise corporate taxes, which we do think will happen, again, we don't think it's as high as the Biden administration wants, it is not necessarily going to stop this bull market run. So that's next. The other thing that they're proposing is higher capital gains taxes on individuals. Here, the point is, again, it hasn't crushed stocks, but the Biden administration is proposing taking capital gains taxes from where they are currently, which is 23.8% up to 43.4%. So that would be a very, very significant tax increase for people who are selling, winners in their portfolios. Again, we don't think that's a starter. We don't think it's going to come in anywhere near a 43% top rate. But to Shane's point, they're also proposing for people making over $400,000 a year to take their top rate from 37 to 39.6. We think that's probably going to happen. The capital gains rate, we don't think it's going to be anywhere near 43%, but it's probably going to go up. And what this chart is showing is what's happened in the next 12 months after capital gains taxes on individuals have been raised. And you can see, if you go back to 69 and 76, it hurt the market. The stock market went down the next 12 months. Part of that was, if you remember those time periods, some of us are old enough in here to remember that, some aren't. But if you remember those periods, we had really high inflation during those periods, and we had really sluggish economic growth. So the combination of that with higher capital gains taxes really hurt the markets. The last 2 times it's happened, the economy was on much stronger footing, but the average is about 6.5%. That still the stock market went up on average, and it went up half the time. Still not too bad. So, but these are some general dangers, facing the markets coming up in the next year or so.
LPL Research right now is saying that the earnings per share target for the S&P 500 is 195. Give you a quick history of where that came from. When they were putting together the 2021 full year outlook back in November, they started the process. The original target was 165. Presentation and the research came out early December. By December 31st, they already revised it to 180. By April, they already revised it again to 195. And I will, barring a pullback, bet they're going to revise it again. Target on the S&P 500 by year end. This has also been revised once, not twice, just once. 4,400 to 4,450. As of this afternoon, the S&P 500 is at 4,375. We're already there. Now, when we started this 30, 40 days ago, it was 200 points less. But because it's a huge run-up, we're already getting there. 10-year Treasury, target 1.75 to 2. Treasuries actually dropped during this period. They're down by around 1.4 right now. So that's how fast things are moving. Earnings, we thought earnings were going to be really strong this year, and they've been. First quarter exceeded all expectations. Second quarter exceeded all expectations. Earnings just started coming out this week. They're blowing those expectations away now. So these numbers are very fluid, and there's a lot of momentum going in a positive direction. So let's talk about when we come out of a bear market. Graph's a little misleading, so I'm going to tell you to ignore the gold or orange, whatever looks like you on the bottom for now. The dark blue is what the market's done the 12 months following a bear market or a drop in the market. So for this argument, for the most recent one, we're going to use March 21st, 2020. They're called the bottom of the market, and that's when, ever since that was the recovery. That's great. We knew the last 12 months have been really good. Go look at your statements. We all know the last 12 months are good. What does it do with the second year? The second year is not 2021. The second year is starting March 21st, 2021. Historically, the market's still up second year. The momentum follows it through to the second year. And it's on average about 13% up the second year. So we don't think this is going to slow down a whole lot. It will slow down. It's not going to be like the huge run-up we had last year. But the market should continue this momentum into year two. I mean, how many people here, and let's be honest, when you were sitting on March 21st, 2020, looking at your account values online, thought that you'd be back to where you were prior to the drop by this point? No hands should go up. No hands should go up, because actually, most of these people in the room I had conversations with, so I know what the conversations were like. But we're saying, listen, it's a COVID story. As we recover from COVID, we will recover in the markets, and we think sometime in middle 2021, we should get back to where we were before the drop. We were there by September. We blew right through that, and most of the accounts right now are up 20, 25+% over those 12 months. The gold or orange bar, everyone, if you just look at a slide, you would think that's okay, what to do in year three. No, it's not. It's what is the biggest 1 month drawdown during year two. So you can see during year two, we typically, the average drawdown, we have a period during year two where the market drops about 10%. So what the takeaway is, we think the momentum is going to continue, but the volatility is going to return. That straight upwards graph you see in your statements every month, it's not going to happen anymore. We're going to start seeing up and downs in the market. It's going to actually behave like the markets are supposed to behave. So expect a 5, 10, 12% pullback at some point in the next 12 months, because it's going to happen. But that doesn't necessarily mean that this bull market's over. Going back to what I said before about how they're revising these projections so quickly. 2020 to 2021, they're looking at a 36% increase in earnings per share. 2022, right now, the projection is 205. That would represent an 11% increase off the 195 we're currently sitting at for what we think it's going to be by year end. So again, corporate earnings momentum is going to continue. And keep in mind, there's a good chance we may blow through that 195 this year. Okay, so safety features. Now I get to talk about the thing that everyone really came here to talk about, the bond market, right? Everyone wants to know about the bond market. No, it does. All right. Right now, I told you the 10-year Treasury is about 1.4. Basically, what LPL is saying is, if you look at gold, the gold and copper index, that's always been a good indicator of where the 10-year Treasury should be. And what they're saying is, based on that, because gold's a good inflation hedge, right now, the 10-year Treasury should be upwards of about 1.7, which is really where we were in April. 1.7 puts them just below the hair of the range of where they think we're going to finish year end. Remember, this was 1.75 to 2. So we do think there are mechanisms in place to start pushing that 10-year Treasury back up into that range by year end. But here's the takeaway. I'm going to just bottom line it for you because I talk to every client in every meeting about this. When interest rates go up, it is a headwind for your bond portfolio. Yields go up, your prices go down. When that happens, every bond you own is now worth less money than it was yesterday. It's a headwind for your bond portfolio. Anyone know what the Fed funds rate is right now? 0. We're not going down anymore. We're not going to go negative rates. So the rates are only going to go up. We don't think the Fed's going to raise rates anytime soon. In fact, it's very likely they're going to continue holding steady well into next year. But they're not the only mechanism that controls rates. Inflation starts flaring up, the 10-year Treasury starts going up, rates are going up. Interest rates go up, bonds go down. So we're sitting here right now saying that we think interest rates are going to go up. We're basically saying we think the bonds you own are going to go down, or at least have a headwind, struggle to have a positive return. So why should we own bonds? They're the safety belt. They're a seatbelt. I just said earlier that we expect there to be a period in time, the next 12 months, to be a 5, 10, possibly 12% pullback in the market. But this graph is showing every time the S&P 500 has been negative, going back to 2020, or a negative month, I should say, U.S. Treasuries were positive. Okay? They are the anchor, they're the ballast in your portfolio. So when the market does drop, we have a little ballast to hold it up. That's why we do this thing called diversification, asset allocation. Okay? How many people have all their money in the S&P 500? Nobody at least who's working with us. We diversified out. We have asset classes that have low correlation to the U.S. stock market, mixed in on purpose to help control the risk. This is why we have to keep bonds in the portfolio, but we have to be smart about it. We have to limit how much we have in core bonds. We have to limit how much we have in treasuries, because they're very sensitive to interest rates. We got to use bond market allocations like bank loans or mortgage-backed securities. Different things that are not as sensitive to interest rates. So as those interest rates are going up, those yields can still hold steady, kick income into the portfolio. So I blew through the slides. I did that on purpose. Because most of us don't want to hear about the bond market. But we do feel there's going to be momentum going through the rest of this year. We'll have to kind of regroup at the end of the year and see where things are. We're not expecting this to quickly turn around and have a big pullback in the market. There will be short-term pullbacks in the market, though. We're expecting volatility to raise its head again. We talked about the economy. We talked about the stock market. We talked about the bond market. With all of that, any questions?